Premiums follow expected loss. Insurers raise prices when future claims are expected to cost more. Concrete case. Repair bills and medical costs rising can lift premiums. The situation shows the mechanism clearly. The risk becomes real when repair bills and medical costs rising can lift premiums. Your claims history matters. Past claims can signal higher future risk. Real case. 2 at-fault accidents may raise auto insurance. Personal history affects price. The price of coverage only makes sense when it is compared with the risk being kept personally. Crime, storms, floods, or traffic patterns can affect everyone nearby. Daily version. A neighborhood with more theft can see higher home premiums. Location risk is shared. The safest insurance decision is made before the claim becomes emotional. Ignoring this can hurt because a customer can do nothing wrong and still see a higher renewal because the risk pool change. Inflation raises claim costs. Parts, labor, building materials, and healthcare can become more expensive. Concrete case. The same car bumper costs more to repair than 3 years ago. Replacement cost affects premium. Skipping this point matters because a customer can do nothing wrong and still see a higher renewal because the risk pool change. Large disasters can make insurers reprice entire regions. Picture. Wildfire or hurricane losses change home insurance availability. Rare events can affect many customers. Looking at catastrophes reshape markets shows what happened earlier, which makes the next choice clearer and less emotional. Coverage changes raise cost. Adding benefits, higher limits, or lower deductibles increases premium. Concrete case. A driver adds comprehensive coverage and pays more. More protection costs more. The mechanism shows up when a driver adds comprehensive coverage and pays more. It shows why premiums rise when expected claims, repair costs, risk, inflation, or coverage changes increase. Notice discounts can expire first. Introductory offers, no-claim discounts, or bundling credits may change. The stakes show up because a customer can do nothing wrong and still see a higher renewal because the risk pool change. The price of coverage only makes sense when it is compared with the risk being kept personally. Credit or risk scores may matter. Some markets use insurance scores or similar risk indicators. Picture. A changed score can alter price even without a claim. Rating factors vary by place. The safest insurance decision is made before the claim becomes emotional. Age and life stage affect risk. Young drivers, older properties, or changing health can influence pricing. Seen when a teenage driver added to a policy increases auto premium. Risk profile changes over time. The real-world cost appears because a customer can do nothing wrong and still see a higher renewal because the risk pool change. Regulation can change rates. Approved rate changes may reflect industry-wide loss experience. Imagine an insurer may need permission to raise certain premiums. Reinsurance costs can also affect premiums. Insurers often buy insurance for themselves so they can handle very large losses. If storms, fires, or floods make reinsurance more expensive, that cost can flow into ordinary customer premiums later. Even someone with no personal claims may see a renewal increase because the wider insurance market has become more expensive to protect. Fraud increases pool costs. False or inflated claims raise expenses for honest policyholders. Think of organized staged accidents can push auto premiums up. Fraud is paid by the pool. The pressure becomes practical because a customer can do nothing wrong and still see a higher renewal because the risk pool change. A careful person would compare repair inflation with medical costs before deciding what the situation actually means. More insurers in a market can restrain premiums. The earlier it is recognized, the less power the pressure has. In practice, separate your personal claim history from wider inflation, repair costs, weather risk, and market pricing. In everyday terms, medical costs matters when it changes what someone spends, avoids, accepts, delays, or repeats. Renewal inertia is expensive. Customers who never compare quotes may absorb increases simply because changing policies feels like work. A similar policy elsewhere may be cheaper, or the same insurer may offer different options if the coverage is reviewed. Before accepting a renewal, compare your personal claim history, repair cost inflation, local weather risk, deductibles, and coverage changes. That separates a justified increase from a price jump that deserves negotiation or shopping around. The everyday problem is risk mitigation can help. Alarms, safe driving, maintenance, or higher deductibles may reduce cost. Imagine installing a monitored alarm can qualify for a discount. Reduce risk where possible. The consequence matters because a customer can do nothing wrong and still see a higher renewal because the risk pool change. The topic becomes real when claims history affects the next choice, bill, conversation, or risk. Cheapest is not always safest. A lower premium may come with weaker coverage, higher deductibles, smaller limits, or exclusions that matter only when a claim happens. For example, a home policy may look attractive until water damage, roof age, or high-value belongings are excluded or capped. Premiums should be judged together with coverage strength, claim history, repair inflation, local risk, and out-of-pocket exposure, not by price alone. Ask why it changed. Insurers can often explain claim, area, coverage, or market reasons. Common case. The renewal notice may not tell the full story. Request details before switching. This affects daily choices because a customer can do nothing wrong and still see a higher renewal because the risk pool change. Premium increases can feel unfair because the bill arrives personally even when the cause is shared across many customers. The issue is more visible when read when renewal pricing is treated as evidence, not background noise. Insurance premiums rise when the insurer believes the future cost of claims is higher. That can come from personal claims, wider inflation, repair costs, medical costs, weather risk, fraud, or changes in coverage. The useful response is to compare, ask what changed, and adjust coverage carefully rather than guessing. A careful customer can still face a higher bill if repairs, medical costs, weather losses, or local claim rates rise. Premiums rise when the insurer expects claims to cost more in the future. That expectation can come from personal claims, repair inflation, medical bills, weather losses, theft rates, fraud, or risk in the wider area. Premiums rise when the insurer believes the cost of future claims has gone up. The problem becomes harder when a careful driver paying more because parts and medical costs rose. Premiums rise when the expected cost of claims rises. The renewal notice is often a mix of personal risk, local loss trends, and higher replacement costs. The renewal bill is often a forecast, not only a scorecard of what the customer did last year. That can happen because of your claims history, local disasters, medical costs, car repair prices, inflation, fraud losses, or broader risk in your area. The bill may feel personal even when part of the increase is market-wide. That cost can come from your own history, local risk, inflation, repair prices, medical bills, disasters, fraud, or changes in the coverage itself. That is why renewals can feel surprising even without a new personal claim. A careful customer may still see a higher renewal because the insurer is pricing the pool, not only one person.